For 2022, the stock market was on a tear. It was a tremendous, in fact, it was the longest bull run in stock market history. But 2022 in an inflationary environment has brought a different environment for stocks, bonds, and spending power for pre and post retirees. Today, I want to share with you how to position your wealth in a way to hedge against the current volatile markets and inflation, even if it is long term. Keep it right here. Good day, everybody. Chris Heerlein here, partner at REAP Financial, host of Retire Ready TV on KXAN, that's News Channel 36 here in Austin, as well as Wealth Radio every Saturday, 1 p.m. on News Radio KLBJ. Thanks for making us part of your day here. If you enjoy our channel, click the subscribe button down below, give us a thumbs up. Today I want to cover a question that recently came in from one of my Wealth Radio listeners, and she asked, "Dear Chris, with the price of everything going up and the stock market going up and down, how can I withdraw from my portfolio in a way to ensure that I don't exhaust my funds for basic needs like food and retirement?" And that's a question that I know many of you have or may be feeling during this economic environment with everything going on politically, economically, I know. But the thing about inflationary environments is when you look at these periods in history, we haven't seen a period like this in 40 years. And so the investments, the type of accounts, the strategies that have worked the last 10, 20, 30 plus years aren't working as well as they once did. And so for many families, you may need to consider different investment approaches. You're hearing a lot more about metals, gold and silver, physical assets like real estate, whether it's passive or you own it personally. You're hearing more about energy and agriculture. These commodity sectors historically in periods of inflation have done okay, sometimes outperforming the broad stock market. Then you also look at bank CDs and I-bonds and MYGAs. We've talked about those in past segments. You can look at that as well. But the thing is that the story of retirement, the story of investing for retirement has drastically changed here in 2022, and I think it will in years to come as well. And so it's so important that you're investing and positioning your assets in a way that even in a stock market going down, you've got assets that are going up or nowhere. You need real zig and zag, and that's why true diversification is really powerful during these economic times. That means it's not just stock market, it's not just large cap and small cap and mid cap and international, it's not just bonds. You need to be invested in asset classes that are going to bring stability to the portfolio in these type of times. And so that could be cash at the bank, it may be fixed rate CDs, fixed rate MYGAs, having real estate that's generating income for you, having some commodities that potentially may be outperforming the broad markets or hedging against a devaluating dollar. You see where I'm going here? This is a different period of time. And so when I think about the strategies that families are using right now to ensure they're not withdrawing too much from their portfolio when the stock markets are down 10, 20, 30%, you need to be positioned and ready for these type of environments. One of the first and most simplest ways is to have a cash reserve. We generally want to see one of our families that we consult with have a healthy cash reserve. That could be up to 10% of their net worth in cash. And I know that you're going, man, that seems like a lot of cash, but we're also coming out of an environment where you weren't able to yield anything on your cash. Today, with the interest rates going up, you can have money markets as high as 3% plus. So at least your money is somewhat treading water with inflation. But see, in that type of environment, with that type of option, you're pulling money from an account that is going nowhere, or even with the interest rates is going up, instead of having to tap equities and bonds that are going down. Very critical that you have a withdrawal strategy in retirement, obviously, but during these type of periods. The second way that people are withdrawing from their net worth, believe it or not, is through home equity lines of credit or reverse mortgages. This allows you to access hundreds of thousands of dollars in your home. Depending on the value of your home, generally you can access up to 80-85% of your home equity. That is equity that isn't going anywhere in the last 8-12 months during this economic period, during this recession that we're walking into. Property values here in Central Texas have stayed relatively strong. And so being able to access a bucket of money via home equity That is a bucket that generally is going to come out tax-free to you, and it allows you to slow down on your withdrawal rate from your portfolio that may be negative right now. Another consideration that people are looking into and utilizing is their Social Security dollars. A lot of families, you may be on a deferral plan right now, but that's $3,000 or $4,000 a month of your budget that could be supplemented by money that's sitting in the government's bank in deferral. So some families are considering turning on their Social Security. Maybe one spouse turns it on, one defers. We have others that are turning both on. And that way you're able to decrease the amount you're withdrawing out of your equity portfolio during a down market, giving it more longevity for when this market comes back up in the next 18, 24 months to rebound and be there for you. There's a number of other strategies. Don't have time to get into them today, but this is some great food for thought, and we have a great new report all around withdrawing from your portfolio in a way to ensure that it lasts as long as you do. Get your hands on it. It's right here on the screen. Email me, retire@reapfinancial.com. It's retire@reapfinancial.com. My team will have it on its way to your inbox.